YCharts is very excited to be joined today by Ric Edelman, founder of the Digital Assets Council of Financial Planners, among other claims to fame. A couple housekeeping items before we get into things. We will be sharing a recording of today's webinar with all attendees. So if you're interested in getting that recording, it should be hitting your email inbox tomorrow, definitely by the end of this week. You can also use the question and answer, the Q&A function at the bottom of your Zoom screen to submit any questions for Ric or for YCharts throughout the discussion. And we will have a dedicated Q&A session at the end of the presentation so that we can answer all those questions you submit through the Q&A. Finally, a little disclaimer, YCharts is not acting as an advising party regarding client funds in any way. We are here to hear the great insights and expertise from Ric Edelman. And with that, I'll introduce Ric here. Ric is one of the most influential people in the financial planning and investment management profession, ranked 3 times as the #1 independent financial advisor in the nation by Barron's. He's also received the industry's Lifetime Achievement Award in 2017. Talkers Magazine named Ric one of the top 100 radio talk show hosts in the country, and he has produced an award-winning special for PBS as well. He's a #1 New York Times bestselling author of 12, that's a dozen books on personal finance, and Ric's newest book, The Truth About Crypto, debuted in May. So without further ado, please welcome Ric Edelman.
Connor, thank you very much. I appreciate that introduction. I'll apologize in advance for my voice. I'm recovering from a cold. All the COVID tests say it's negative, but you know what that means these days. So feeling pretty good at this point. I'm looking forward to this conversation. I'm going to blow through, I don't know, maybe 80 or 90 slides that I've prepared for you today. I'm going to blow through them as fast as I can so that we can get into the fun part of Q&A with Connor. So as he mentioned, write down your questions, enter them into the chat and into the Q&A box on the bottom of your Zoom screen. It's a crypto winter we're in right now. It's feeling pretty cold out there, but we're going to talk about what's going on now versus what's been happening the last 6 weeks versus what's been happening the past 6 to 9 months. Here's the bottom line number that really we need to be paying attention to as financial advisors. 20% of all US adults right now own Bitcoin. Now, if it's 20% of all US adults, we know that most of those people are affluent. Well, right? Only affluent people can afford to invest. Poor people generally don't buy investments. So your clientele are affluent, which means if 20% of overall adults own Bitcoin, odds are pretty good a lot of your clients own Bitcoin and other digital assets. Often without you knowing about it, your clients are buying Bitcoin the way your teenagers are drinking beer. They're doing it and they don't want you to know. What about millennial millionaires? 83% of them own crypto. This is according to CNBC. Even teenagers, and asked by T. Rowe Price in their annual Teens, Parents, and Money survey, they said, what would you do if we gave you $100 to invest? And 57% said they would buy crypto. Only 38% said they buy stocks. In fact, teenagers, half of them say crypto is the future of investing. So if you have any aspiration for being in business for a long time, dealing with millennial millionaires today and their children tomorrow, you need to recognize that those folks think it's all about crypto. And what about your existing clients? 82% expect you to be knowledgeable about crypto. And these days, they need a lot of advice. We've seen incredible news over the past few months. We saw the collapse of the Terra Luna, the big stable coin. We saw Celsius froze withdrawals. Voyager Digital has gone bankrupt. Coinbase, Gemini, and many others are engaging in massive layoffs. This is raising a lot of questions among a lot of those who have been engaged in crypto over the past year or more. What is going on? What does it mean? What should I do? What's your advice? We need to begin by acknowledging this really isn't, though, about crypto. It's about the world economy. We know what's going on in the world. I don't need to waste time talking about all the words on this slide. You know as well as I do everything going on in the world economy at the moment. The National Association of Home Builders has issued a clear recession warning BlackRock's Ric Edelman, the head of fixed income there, calls this situation a Category 5 hurricane. Everything's down everywhere. The stock market hit a bear. 30-year T-bonds are down 30%. Gold is down 8%. So much for gold being an inflation hedge. New home sales are down 28%. Refinancing's down 75% over a year ago. And in the middle of all this carnage, Bitcoin fell 70% from its November high. This isn't, though, just about crypto. Look at the stock market. Look at the biggest one-year declines. Peloton, Carvana, Snapchat, Roku. Bigger declines by far than Bitcoin's. The biggest 1 month decline, GameStop, Netflix, Facebook, Meta now, Rivian, and so on. Bigger declines than Bitcoin. 1 week declines over the past 2 years, some of them bigger than Bitcoin's. 1 day declines. Netflix fell 35% in a single day. Bitcoin hasn't done that. From their all-time high, some of the best-known stocks have fallen 90% or more in value compared to Bitcoin's 70%. But all of that data, and I mentioned that to you just to put it in context. When people say, gee, Bitcoin's down 70%. Well, I don't see anybody talking about putting Netflix out of business, down 90%. So what we have to recognize is that all that data that I just gave you, which are all just interesting data points, that was all so last month or last 6 or 8 weeks. Since their lows, Bitcoin is up 27% in the month of July. Ethereum is up 65% in the month of July. The NASDAQ is now not in a bear market, it's now in a bull market. Look how fast things can turn around. That's not a real shock to you as a financial advisor. You've seen this game play out before. Meanwhile, what's really going on in the world of crypto? Well, Uniswap is a decentralized exchange. They have now just hit $1 trillion in lifetime volume. They're the first decentralized exchange to do $1 billion of business in 24 hours. Compare that to the NYSE, which does about $1.5 billion a day. NASDAQ only does 700 million. Uniswap, you've probably never heard of it. It's 4 years old, founded by a college dropout. The company's got about 35 employees. Compare that to the NYSE with 3,500 employees. Uniswap, under the radar, most folks never heard of it, a bigger business than NASDAQ. JP Morgan Chase in May began using blockchain to settle trades. This is what they said, quote, "We've achieved frictionless transfer of assets on an instantaneous basis. JP Morgan is expanding settlements to include stocks, bonds, other asset classes. They call this significant upside for crypto investors. They say Bitcoin is undervalued by 28%, and they're now offering clients 6 new crypto funds." At Citi, they've announced they're hiring 4,000 tech staff, a quarter of them on their technology team. They said, quote, "We're trying to digitize as much of our client experience as possible. Those that do are going to create competitive advantage." At Fidelity, their huge digital assets team is doubling their headcount to meet demand from institutional clients. MasterCard's CEO said at Davos in May, SWIFT won't exist in 5 years. That's a huge deal. SWIFT is the global system that the entire financial network uses to move money from one country to another. He says it's not going to exist, going to be replaced by blockchain. The big venture capital firm by Andreessen Horowitz, A16Z, has raised $4.5 billion for a brand new crypto fund. In June, Maxine Waters, the chair of the House Financial Services Committee, said, quote, "We're in a new digital assets space race, and America can't be left behind." And on the other side of the aisle, Ted Cruz said, "I believe in Bitcoin. I want Texas to be the oasis on planet Earth for Bitcoin and crypto." The world big law firm Holland and Knight issued the first temporary restraining order as an NFT. Persuaded a judge, we will be able to issue this, getting into the hands of the people involved in this case quicker, with more security and certainty than any other form of delivery. So, given all of this, what should you be telling your clients in an environment like this? What do you say to clients who are very fearful of the fact that Bitcoin fell 70% in value, that there's so much news on a daily basis of the latest fraud or the latest scam, the concern we have going into this economic environment in Q3 and Q4, with an election coming up in the middle of all of it, with a saber rattling, not with Putin and his aggression in Ukraine, but now China and it's being upset over Taiwan. What do you tell your clients about all of this in crypto? It's real simple. You should be saying to your clients exactly the same thing you say to your clients about stocks. I mean, think about it. What do you say to your clients when they express concern about the stock market? Well, you tell them very simply, you don't sell because prices go down. What do you say to them? We manage risk. First, we need to diversify. Sure, we've seen big price declines. This is why we don't have all of your money in this one asset class. And we diversify broadly within that asset class to reduce the level of risk, to help to manage and control that risk. And we need to maintain a long-term perspective. Everybody who's been a long-term investor knows we've seen this game before. We saw it after the crash of 87. We saw it in the recession of 92. We saw it in the dot-com bubble. We saw it after 9/11. We saw it after 2008. We saw it after the pandemic. We've seen this before. We know that it's all part of the business cycle, and we need to maintain a long-term perspective. We're not investing in order to make money in the next quarter or the next year. We're making money to position the portfolio and your long-term financial security over the next decade, the next several decades, your entire lifetime. We need to maintain a long-term perspective. And we can take advantage of short-term volatility by exploiting dollar cost averaging, by recognizing that by investing over regular intervals, you do this in your 401k with every paycheck, you can do it easily with any mutual fund or exchange traded fund or any diversified portfolio, add money on a monthly basis. That smooths out the volatility. When prices are high, you don't buy very many shares. When prices are low, you load up with lots of shares. Dollar cost averaging produces, as you know, the most cost-efficient accumulation of shares possible. Let's put volatility to our benefit through dollar cost averaging and rebalancing. Let's make sure that as portfolio values fluctuate, as one asset class falls more than another, we take advantage of that by rebalancing. As one asset class rises, we sell some of it. While there's another asset class lower in price, we buy some of it. This rebalancing helps to reduce portfolio risk and helps to ensure long-term profits thanks to the way that rebalancing works. And finally, tax loss harvesting for our taxable accounts. You've got losses in the account in 2022. Let's take advantage of it through tax loss harvesting. This is what we tell our clients every single day about the stock market, about ETFs and mutual funds, about bonds and real estate and gold and oil and gas and natural resources. All of that, all of it is equally applicable to crypto. Because at the end of the day, crypto is just another asset class. Whether you like it or not, doesn't really have anything to do with it. It doesn't matter whether you are a believer in crypto, whether you like crypto. If you believe in diversified portfolios, you already have in your clients' accounts assets you don't particularly like. That's not germane to the conversation. If we believe in diversification, we believe in adding as many different asset classes as possible to smooth out the volatility, to improve our measurements of the Sharpe ratio and the standard deviation and the Sortino ratio. We want to reduce the max drawdown. That's the whole point of diversification. We do it with all other asset classes, and we should simply acknowledge that crypto is the first new asset class in 150 years. It's really that simple. Market declines for diversified long-term investors are simply a buying opportunity. And so we need to make sure that we're putting crypto into context. Let's also keep one really important statistic in mind in this effort to putting it into context. Most people who buy crypto have a very low allocation. My personal advice has been a 1% allocation into crypto. If you're going to do a 1 or 2 or 3% allocation to crypto, you probably have lost more money this year to Facebook than you have to Bitcoin. Because if you have an S&P 500 stock index fund, Facebook is 1.4% of it. You likely have bigger losses there than you do in Bitcoin. So let's put it into context. And to help us do that, we really need to make sure you're getting the education that you need so that you can, in fact, guide your client effectively. And that's what I do in my creation of DAC-FP. We need to recognize in teaching you that blockchain technology lets businesses operate faster, cheaper, safer, with greater transparency and inclusion. The annual transaction volume of Bitcoin is $3 trillion. That's 3 times more than American Express. Blockchain tech is going to grow 10x over the next 4 years. 90% of the world's banks are developing blockchain technology. 3 out of 4 universities are offering courses on blockchain now. You can get college degrees in this stuff now. Last year, Bank of America alone, all by itself, filed 161 patent applications for digital payments technologies. JP Morgan Chase says blockchain is going to save banks $120 billion a year. PwC says it's going to add $2 trillion to the global economy by the end of this decade. And crypto is going to generate $5 billion in AUM fees over the next 5 years. Now is the time where you can add value to your clients. And that means now is the time for you to make sure you have the knowledge you need so that you're fluent in this conversation and you can effectively answer your clients' questions. What is blockchain? What is Bitcoin? How does it work? Why should I care? How should I invest? How much should I invest? And where should I invest? And to help you get that knowledge you need, at DAC-FP, we've created the certificate in blockchain and digital assets. It's an online, self-paced, self-study course. You get 13 CE credits. Take it at your own pace. First half of the course is all about the tech. What is blockchain? What is Bitcoin? How does all this work? The second half is all about the practice management, the investment thesis, the investment opportunities. How do you build a portfolio? Regulation, compliance, taxation, and most importantly, how do you talk to clients about all this? The course is just $679. There are discounts available as well. And this will demonstrate to your client, you're staying cutting edge. You're learning all about the latest new asset class, demonstrating that they can rely on you for the advice that they need, whether it's to buy or not to buy Bitcoin, and if so, how and how much. So I encourage you to get your certificate in blockchain and digital assets and to read my new #1 Amazon bestseller, The Truth About Crypto, which is getting rave reviews online. So with that, I'll turn it back to you, Connor, and we can continue with our Q&A and conversation.
Excellent. You hear me okay, Rick?
Yeah.
Okay, I'm back. Thank you so much for that, Rick. Lots of, stats that really make you pause and think about the headlines you've been reading for sure. Kind of get into some questions here. So one came from Julie, and she is wondering if investing in blockchain technology is a, quote, rational way to get exposure to digital assets, and gave the example of the BLOK ETF from Amplify ETFs.
Yeah, there's it's really interesting. There are now many ways to allocate to crypto. And I couldn't have said that as recently as 3 years ago. So the industry has really grown up and matured a lot. This is one reason you're seeing institutional engagement for the first time. So it's worth taking a couple of minutes to talk about the different options that are available to you. One, obviously, you can just buy Bitcoin or Ethereum or other digital assets. And you open a Coinbase account or a Gemini or Kraken or wherever you like, and you just buy the assets directly. It's really no different than opening a brokerage account at Merrill or Schwab and buying stocks. So you could do that if you like. It means opening a new account. The problem with a lot of these exchanges is that they don't really work with the advisor marketplace directly. So many advisors struggle to manage the client portfolio and really do their job as a manager to oversee that. It can be cumbersome and difficult. And if you don't buy individual stocks for a client, then why would you want to buy individual digital assets for a client? It just is a different way of running your practice. So a lot of advisors kind of hesitate at doing that. Many advisors are also prohibited. Their compliance department won't let you. because they themselves are struggling to figure out what are the regs and what are we allowed to do and what are the risks, et cetera. So buying individual coins directly isn't a path that most advisors have yet decided to take. In the old days, that meant I'm done. There's no other alternative. But today there is, as you mentioned in your question. One example is to buy an ETF. There are now dozens of ETFs in the marketplace, and you named one from Amplify. They also come from Invesco and Global X, Schwab, BlackRock, Bitwise. There's a couple of dozen of them on the marketplace right now. These ETFs don't buy Bitcoin. What they buy are stocks of companies that are engaged in the digital asset space. We call it the picks and shovels strategy. That name, of course, comes from Levi Strauss. Back in the California gold rush, he didn't mine for gold. He sold blue jeans to the gold miners. So he became the wealthiest guy of all because whether or not you find gold, he makes money selling clothes. John Nordstrom did the same thing. He sold work boots to the gold miners. And of course, Nordstrom today is super famous for their shoe selection in their clothing stores. So that's what these crypto ETFs do. They buy stock, for example, in Coinbase, publicly traded exchange. They buy shares of Riot Blockchain, which is a publicly traded Bitcoin miner. They buy shares of Silvergate Bank, which is the biggest and first digital crypto bank. They buy NVIDIA, which is the chip maker that makes the chips that go into those computers that the Bitcoin miners use. So these ETFs will buy, they typically hold 30, 40 different stocks of companies that are in the infrastructure. It's kind of like saying I'm a big fan of cars, but instead of buying Ford or GM, I'm going to buy stock in an asphalt company. And it's a very similar approach. And so this directionally gets you involved in the space without actually buying Bitcoin. So that is one clear way you can do this. Now, because you're not actually buying Bitcoin, the prices of these stocks, which generally move thematically in sync, aren't necessarily identical. So that you might find a difference. For example, you've seen the difference between buying gold versus gold mining stocks. They usually move in sync, but there can be some divergence. And these ETFs will be similar. But it thematically allows you to say to the client, if you want to have an exposure to crypto, these ETFs do provide that. You're directionally in sync. And it's an ETF, and you know exactly how ETFs work. And the client's familiar. We all love ETFs for the obvious reasons. They're transparent, they're low cost, they're liquid, and you can easily add them to a diversified portfolio, easily rebalancing, dollar cost averaging, tax loss harvesting. You can debit your fee. That matters. So they're very simple and easy to use. So those ETFs are certainly a good idea. Another related idea are what we call proxy stocks. And the most famous of them is MicroStrategy. MicroStrategy is a business intelligence services company, but Michael Saylor, who just left as CEO, he's now chairman, bought about $6 billion worth of Bitcoin. So the stock moves up and down with the price of Bitcoin, even though it's a totally separate business intelligence company on top of that. So by buying stock in MicroStrategy, you're in essence buying a mirror of Bitcoin, and they call it a proxy stock. So you could buy MicroStrategy and a few other stocks like that as well. Again, buying a stock, not buying Bitcoin directly. You could also buy an over-the-counter security. These are issued by Grayscale, Bitwise, and Osprey. These OTC securities actually do directly own Bitcoin. The Grayscale Bitcoin Trust, GBTC, or the Grayscale Ethereum Trust, ETHE. They buy Bitcoin, they buy Ethereum, and they trade over the counter. Because of that, they have a premium or discount feature, meaning that they trade like a closed-end fund. Recently, GBTC was trading for a 35% discount. you're able to buy $1 worth of Bitcoin for 65 cents. The question is, will that discount ever go away? Might it even get worse? So you need to be aware of that feature. There are also Bitcoin futures ETFs. If you want to get an ETF that has a Bitcoin investment, but it's futures contracts, and if you're not buying stock futures, why would you want to buy Bitcoin futures? If you want a more diversified play, I would recommend the Bitwise 10 Crypto Index Fund. The symbol is BITW. This is a fund that buys the top 10 digital assets, Bitcoin, Ethereum, and then the 8 next largest. It's another over-the-counter security, and that's another way for you to get a diversified approach, but doing it within a brokerage account in a security that doesn't have any regulatory challenges or uncertainty, that allows you to easily add it to a diversified portfolio, easily allows you to manage the account and debit your fee. So the ETF route, the ETF futures route, or the OTC route using Grayscale, Bitwise, or Osprey, those are the easiest ways for advisors to go. And I'll mention one final choice, and that's an SMA. Separately managed accounts. The biggest and oldest is Eaglebrook Advisors, where they allow you to custom create a portfolio of crypto. So it allows you to offer a customized version that allows you to manage the account directly for your client that delivers a higher value add than buying an ETF. So you've got this wonderful array of options that are available in the marketplace today that didn't exist as little as 3 years ago.
That is, yeah, fantastic. I mean, you gave a wealth of options, like you said, some that can be part of that advisor wallet share, some of which we discussed buying the coins directly. And I think Julie did mention that was kind of the nature of her question. Is it difficult to have a client going and opening up one of these accounts on some company they've never heard of before, but great options in terms of ETFs, SMAs, trusts, the proxies. Excellent.
Yeah, the big issue here is not merely is it difficult for the client to do it. The equal question is it difficult for me to help the client in doing it? And advisors want to stay involved. You don't want to lose the assets to the client moving them to Coinbase. You want to make sure that you can manage the assets, that you can continue to integrate it in portfolio modeling and rebalancing and reporting and so on. And that's kind of the challenge. So these other routes can help address all of that.
Yeah. And as you did mention as well, very important to note, what is it that you're actually gaining exposure to with whichever vehicle you do choose? Is it right, the picks and axes, or are you getting the gold itself?
Right.
Great. Another question from Tom, which is part of this, bringing the assets under your purview as well. What custody options would you recommend to clients?
Well, custody is a huge question. It's a really important question. I'm hemming and hawing only because there's so many different ways to talk about it. So I'll say this. If your client is going to go the direct route, meaning they're going to open an account on a platform, you want that platform to be a qualified custodian. That gives you confidence that they have achieved regulatory approval at either the federal or state level, that they're conforming to all the rules associated with that, KYC, AML among them, that they have proper safeguards from a cybersecurity perspective. And in my book, The Truth About Crypto, we have a lot of due diligence questions you should ask custodians when you're deciding which ones to recommend for your client. Some, for example, like Choice, has $20 billion in assets. They have 22 different digital assets that you can buy. You can also buy stocks and ETFs and mutual funds on the platform. They seamlessly work with advisors. They upload data to Orion. You can do block trading. You can do your fee debiting. You can do rebalancing. They work really well with advisors. Other custodians don't. They work directly with the consumer, but not with the advisor. So you want to evaluate on that basis. Another good choice is Prime Trust. They're another good qualified custodian. So You want to make sure that your platform is a qualified custodian, because some of these platforms are not qualified, meaning they haven't gotten the regulatory approval. Some of them are offshore. You have no idea where they're located. So you do want to have those levels of protection. And in my book, as I said, The Truth About Crypto, there's a complete due diligence list of questions you should ask when evaluating custodians.
Excellent. And we do have another question on the custodian topic, but really quickly, I'd like to launch a quick poll to everyone attending and just get some, kind of take the temperature of the room here. So which best describes your current and or planned approach to crypto assets in clients' asset allocation? So if everyone could take some time here to contribute an answer, we're curious just to see, where the room's heads are at. But a question from Dan while you're all punching in your answers. Dan is asking, how concerned should crypto investors be about those custodians, example, Coinbase, in the event they run into financial problems of their own? And you referenced some of this at the start of the presentation, Rick.
Yeah, you've got to be worried about it. In fact, Coinbase recently made news when they announced that if they go bankrupt, the coins that they're holding on your behalf, meaning the Bitcoin or Ethereum that you bought from them, that they're holding on your benefit, could be caught up as a creditor liability. So you do need to be concerned about the financial solvency of the platform you're using. In Coinbase's case, they say that they've got massive amounts of financial liquidity and resources and cash. They're a multi-billion-dollar company. So I don't know that I'd be terribly worried about Coinbase. I have a Coinbase institutional account. I own shares of Coinbase. I'm not worried that Brian Armstrong is going to have the company implode anytime soon. So I don't think that's a current worry to have. But you always have to ask that question, will my provider fail? You have to ask the same question in the stock market. Most of the custodians we use in the stock market are so big and have been around for so many decades or centuries. Merrill Lynch, Charles Schwab, Fidelity. We don't even ask the question anymore. Are they financially sound? But you do have to ask that question about crypto platforms because it's still a pretty new marketplace. So the biggest in the industry, Binance, FTX, Coinbase, Gemini. I think I would choose one of the so-called brand names than some smaller outfit that you have never heard of or don't know anything about.
Yeah. And I think too, the recent news with BlackRock and Coinbase entering into a partnership, I think that gives a lot of trust and credence to Coinbase or those names as well, as you see. Yeah. Exactly.
I think that makes a lot of sense. For example, I mentioned Choice, an IRA custodian that's a qualified custodian. They custody their assets at Fidelity. Well, so you might say, who the hell is Choice? Well, knowing that the assets that you buy through Choice are actually at the custody of Fidelity, that gives you a lot of confidence. So I agree with you, Connor. That makes a lot of sense.
Yeah. Okay. Slight gear change here as another question came in about taxes. So how about tax consequences, advisor portfolios, especially with some of those futures-based ETFs?
Yeah. So I'm going to give you an answer to that question, but as a prelude, I'm going to tell you this. We've produced a 2-hour webinar called Crypto Taxation. You can access it when you enroll in our certificate program at DACFP. So the fact that there's a 2-hour webinar, a 2-hour module on crypto taxation suggests that there is a lot to talk about. So I'll summarize it for you here as best I can in just a couple of minutes. First, there is a lot of clarity, more than people realize, about crypto taxation. And with a lot of that clarity, you already know how it works. I'll give you a couple of examples. Bitcoin is property. That's what the IRS says. That's what the SEC and the CFTC say. it's property. Therefore, capital gains rules apply. And you know how that works: long-term, short-term, wash sale rule, on and on and on. You know how all that stuff works. There's no confusion about that. On the other hand, I mentioned the wash sale rule. Bitcoin and Ethereum are not securities. So says the SEC. Because they're not securities, the wash sale rule does not apply. Meaning you could sell Bitcoin today, take the loss this year, and immediately rebuy it. You don't have to wait 30 days. You don't have to be out of the market. Can't do that with IBM, can't do that with Google, but you can do it with Bitcoin and Ethereum. So that's a wonderful tax planning opportunity you can give to your clients. Do you own Bitcoin? The reason I ask is that you could sell it and rebuy it instantaneously, strictly for tax purposes. That's a pretty cool way for you to show value add. So a lot of the rules are very known, very clear, such as the wash sale rule, the capital gains rules, and so on. But on the other hand, there's a lot of uncertainty because some of the elements of crypto are brand new. Staking, for example, that is a feature that was invented with the proof of stake blockchain. The IRS has not explained what staking is tax-wise. So if you earn income from staking, is it taxable? And if so, when is it taxable? When you receive the staking reward or when you sell the coins that you got? And if it is taxable, what's the tax rate? Is it a capital gain or is it ordinary income? The IRS hasn't yet explained its answer. So staking and mining are a couple of unanswered questions. Forks and airdrops are also uncertainties. So at the moment, we think enough info. The general attitude is that you receive ordinary income, plus it creates basis in the future. I'm mentioning all of this to you to illustrate that it's complicated, and you can create a lot of value to your client who has no idea the tax issues, to say to them, if you're engaged in buying digital assets, if you are staking, if you are lending, if you are mining, if you are receiving airdrops or forks, I can help you make sure you're complying with the IRS rules. Because what your client does know is that the very first question on the 1040 asks if they are involved in crypto. And the fact that the IRS put that right on page 1 of the 1040 2 years ago, that's the IRS's way of saying, we know you're buying and we know you're not reporting and we're tired of it. So clients need to be compliant. You can really be very helpful. In fact, I'll tell you this, there is a whole new industry that are called tax tracker services. These are companies that do the tax reporting for your client. They handle all the transactions. They keep a record of it. They actually will populate the IRS forms for your client, uploading it to your tax software. It's incredibly simple and easy. And you need to make your clients aware of this kind of stuff. Everything that we're talking about here, Connor, these tax tracker services, the different types of investment opportunities, the SMAs, the IRA custodians, the crypto ETFs, all of that is available online at DAC-FP. We've created the DAC-FP Yellow Pages. And the Yellow Pages is a free listing of all of these companies, all these vendors, all these fund managers that offer all these products and services. It's available to you for free. Just go to DACFP.com and you can get a list of all of the companies whose names I've been citing to you.
Excellent. And yeah, we did have a question come in about DAC-FP. And so that answers some of the other offerings that you are providing to advisors and by that value chain to their clients who are looking for answers to these questions. Our own question to you all, just really quickly looking through these poll results, which best describes your current and or planned approach to crypto assets? About a third of people saying crypto assets are not part of the current allocations, but plan to start offering. Slightly fewer say that they do not plan to add anytime soon. So Rick, you've got some more convincing to do. And 16% saying that crypto assets are already part of their clients' portfolios and overall strategies.
So these are fascinating survey results here, Connor. Let me address that last group where I've got some persuading to do. I'm going to demonstrate to you why you need to pay attention to this asset class. And you are, otherwise you wouldn't be at this webinar in the first place. I mean, if you're not interested in buying Bitcoin, what are you doing here? It's because you are interested, and that's good for you. Here's why you need to be interested. Even if you don't like crypto, even if you have no intention of ever recommending crypto, your clients are curious. Your clients are interested. Many of them already buying. So if you're unable to effectively converse, you're going to look foolish. I mean, the way I like to put it in context are annuities. We all have very strong opinions about annuities. Advisors love them or they hate them. They use them or they never do. But whether you hate annuities or not, you're able to explain to your client very clearly why you feel the way you feel. My challenge is simply that you be able to do the same with Bitcoin. It's not a matter of whether you like it or whether you're going to recommend it. It's simply a matter of being able to be conversant about it. That's the only way you can assist your client and give them advice that's in their best interest. And I'll give you an example of this. When you're doing a client review, you ask your client for update on their situation. It's a routine part of the business, right? You know, tell me what's going on in your life. How's the family? How's everybody feeling? Any births or deaths in the family? You planning on quitting your job? You changing your career? Have you been promoted? Did you get new stock options? Tell me what's going on. Tell me about your real estate. Did you buy any vacation home? Did you refinance your mortgage? Tell me about your life insurance. How much do you have? Where did you buy it from? What kind of policy? Who's the beneficiary? Tell me about any annuities you own. Tell me about your 401k. How much money's in it? What's the asset allocation? We ask these questions not because you sold any of it to the client. You didn't sell them the annuity or that vacation home. You're not managing the 401k. You didn't buy them any life insurance, but you want to know all this stuff because it helps you in the advice you do give them on a broader basis. And in the same token, ask, do you own any digital assets? Do you own Bitcoin, Ethereum? If so, where did you buy it? How much do you have? What's the platform you're using? Is there an account registration? Because you want to make sure they're not over-concentrated. You want to make sure they're not using a risky custodian. You want to make sure that they aren't overweighted. You want to make sure that they're handling their taxes correctly, that their estate planning documents accurately reflect the existence of these assets. In other words, you want to do your financial planning job. Has nothing to do with liking Bitcoin or not. I might hate annuities, but I still want to know if you own one. And I want to know how much is in it and which company you chose and what kind of annuity it is. Crypto's the same thing. So you can build your practice. You can improve value to your client without ever actually owning or recommending Bitcoin. And that's why you need to get the certificate in blockchain and digital assets to show your client it's about knowledge, competency, fluency, not about whether or not you like something.
Excellent. Information at the end of the day, information is still very valuable. Another question here, not to put you in a spot, Rick, but making note of the talking heads, the Oracle of Omaha and his sidekick have recently made headlines for their negative opinions, bashing crypto altogether. What do you make of that kind of, very loud voice with?
Well, when Warren Buffett calls Bitcoin rat poison squared, when Jamie Dimon says Bitcoin has no intrinsic value, you've got to pause. You've got to say, wait, these are two of the smartest men in our industry, the most experienced, managing more money than darn near everybody. And for them to say this thing is nonsense, you do have to wonder, is Ric Edelman and everybody like him crazy? So we do have to talk about Warren and Jamie. here's why I believe they say what they say. First of all, Warren and Jamie are both very quick to say they don't know anything about Bitcoin. And it really annoys me when people say, I know nothing about something, but let me tell you my opinion anyway. So that bothers me. But putting that aside, what I've learned in my decade in the crypto space, I've talked with thousands of financial advisors and market analysts and money managers. I've learned that the more knowledge you have about Wall Street, money management, asset management, the more experience you have managing money, the more professional degrees, professional designations, college degrees, the more clients you've been managing, the more decades you've been doing it. And that describes most advisors these days, certainly describes Warren Buffett and Jamie Dimon. The harder it is for you to get your head around Bitcoin. And the reason is we're skilled through all of our training, all of our experience in how to value stocks. And we're really good at it. We know how to do this. We look at a company, its management, its employees. We look at the product. We look at the competition. We look at the revenues. We look at the profits. We look at comparables. In other words, hey, if this car company got sold for X multiple, that helps inform what my car company is worth. Well, if you try that with Bitcoin, watch what happens. It's not a company. There are no management. There's no employees. There's no product. There are therefore no revenues. There's no profit. There are no comparables. There's nothing like it. All of those numbers are zeros, leading you to conclude Bitcoin has no intrinsic value. It's all zero. And this is why Jamie and Warren say that. So my only retort to them is they might be right. Maybe Bitcoin has no intrinsic value. But I will say this, it sure as hell has a price. And today the price is $24,000. The marketplace has set the price. And the marketplace says that there's a value there. And it's based on the law of supply and demand. It's also based on another law called Metcalfe's law. This is the statistic that Wall Street market analysts use to determine the value of a network. AT&T is a network. Netflix is a network. Facebook is a network. And what they have discovered over the decades is that in the efforts to value the network, it's based on the number of users on the network. That as the number of users grows, the value of the network grows exponentially. If you look at the number of users of Facebook over time, from 300 million to now 3 billion, Facebook's stock didn't grow 10x, it grew up 100x. The value of AT&T network, the value of Netflix network, the value of Disney with its streaming. This is what Bitcoin is. It's a network. And as the number of users on the network grows, the price of Bitcoin grows exponentially. This is something that Jamie Dimon and Warren Buffett do not acknowledge. And I'll give you one final data point. The two of them, many have argued, are complaining about Bitcoin because they don't want to admit publicly that Bitcoin and blockchain tech more broadly is an existential threat to today's banking system. We don't need banks with Bitcoin. If I want to move money from New York to London, I need a bank to do it. I need to wire the money, and it takes 5 days and costs 5%. With Bitcoin, I can do it instantaneously and free without a bank account. This is a threat to Jamie Dimon and his bank. This is a threat to Warren Buffett, who's one of the biggest investors of banks in the world, including Wells Fargo, and including Mexico's biggest digital bank. This is what's fascinating. Warren thinks Bitcoin is worthless. He's the biggest investor in Mexico's biggest digital bank. So he's either lying or he's unaware of what his own investment is doing. So I'll leave it at that for you to consider the point counterpoint of Warren Buffett and Jamie Dimon.
Lots of great arguments there. And I think on that the Mexican digital bank that you mentioned, I'm not familiar with this issue in detail, but just the sheer amount of dollars that are sent from earners in the United States abroad these days, great application of that technology, like you just mentioned.
It's $800 billion a year gets moved as cross-border transmittals from individuals who send money back home. Immigrants come to the US for economic opportunity and they wire money to mom back home. Traditionally, they'd have to do it through Western Union, but now they can do it with Bitcoin. And when El Salvador allowed Bitcoin as currency, as legal tender, Western Union lost $400 million in revenue because people stopped using Western Union. So yeah, this is a transformative and threatening disruptive technology to the status quo. And that maybe, just maybe, that's got Jamie Dimon a little worried.
We will certainly chew on that for a little bit. Ric, one final question here to wrap us up. We've talked about regulation in general, but curious, what is on your mind? What are you looking forward to or expecting in terms of federal, any level of government regulation on crypto assets?
Yeah, I spent a lot of time dealing with this issue. I'm involved with the Chamber of Digital Commerce and the Association of Digital Asset Markets. And I'm the one who was on stage at the DC blockchain event in May when I interviewed Senators Lummis and Gillibrand when they launched their major legislation on crypto, where they are advancing the regulatory status and in their bill not rewarding, but awarding regulatory authority of crypto to the CFTC. I've interviewed several commissioners of the SEC. I just had on my radio show Jim Himes, who just issued a white paper on a CBDC, and so on. And I can tell you the following. There are now dozens of bills in Congress for the regulation of crypto. We are not likely to see any legislation this year. There's only a couple of weeks left in this year's legislative session because of the election. But we will see major legislation next year and in 2024. I'd say by this time in 2024, so give us 2 years, you will see substantial amounts of regulation and legislation that will provide a massive amount of clarity regarding how Wall Street is allowed to engage. And that's what Wall Street's been asking for. It's not that they don't want to engage, it's that they aren't sure how they're allowed to. And the investment banks, the commercial banks, the brokerage firms, the money management firms, we're talking everybody from Morgan Stanley and JP Morgan and Goldman Sachs to B of A to BlackRock, State Street, Vanguard and Fidelity and Schwab. Everybody is saying the same thing. We don't care what the rules are, just give us the rules. Set the speed limit at whatever you want. We'll drive within the speed limit. Just what we don't want is to be arrested for speeding without knowing we're speeding. Regulation by enforcement nonsense that the SEC is infamous for. So we're going to see this amount of attention. There is now a congressional blockchain caucus with more than 40 members. There is a huge amount of interest in this. The Federal Reserve has hired the first chief innovation officer, Sunena Tuteja, who is a former executive from TD Ameritrade. The White House created in April an executive order calling for the full support of the development of these technologies to support the innovation of blockchain and digital assets. The Financial Services Committee in the House is all over this. So we are going to find that a lot of clarity is coming. And when that clarity comes, so will engagement by Wall Street, because they'll no longer be afraid. And when that happens, you will see institutional involvement of a massive scale. And it's going to have an incredible impact on the price of Bitcoin, Ethereum, and other digital assets. So you can either wait for all that to happen, or you can invest now before that happens. And either way, in 3 or 4 years, you're going to own digital assets. Now, you can buy Google today, or you could have bought Google in 1995. It's entirely your choice.
Thank you very much for that perspective and listing some of those very tangible things that are coming down the pike. I think everyone will be excited about clarity. I'm personally not excited for additional questions come tax time that I need to figure out the answers to. However, Ric, any closing comments or closing thoughts here as we say we part ways?
Well, crypto has gone mainstream, and the crypto winter that we're in right now has caused the price to go from 68,000 to 24,000. You can buy it for 2/3 off. And this is the buying opportunity you've been waiting for. And if you want to show value add to your client, you want to get yourself the education you need now so you can figure out what your advice for your client ought to be. And that's all we do at DAC FP. And so I'm thrilled to partner with YCharts. The work you all do is astonishing. You're a market leader in the information that you make available to help advisors in their practices. And I'm a big fan of the work at YCharts. And I encourage advisors to engage with you and to also turn to us here at DAC FP, because we can be really helpful in your journey in learning about digital assets so you can use it to build your business. Let us know how we can be helpful. Enroll in our certificate course and read my book, The Truth About Crypto.
All right, you heard all of those takeaways. Thank you so much, Ric Edelman. Again, we will be sending the recording and all the information regarding DAC FP after the session. So links, discount code, the slide deck itself, you can look for that to come shortly. Thank you again, everyone, and thank you, Ric Edelman.
Thanks, Connor.